I've had a couple of questions from students regarding this problem where we're attempting to calculate a markup percentage using the absorption costing pricing model as well as targeted pricing. And in this model, what you'll see is that we also go through the process of validating what the numbers are. So again, what we're looking at is we're looking at the absorption costing pricing model. And the first thing that we want to do is to calculate the markup percentage. The markup percentage includes both a denominator and a numerator. Let's talk about the denominator first. What we want to be able to do is to calculate our manufacturing cost per unit. This is going to be the denominator. To get to this, essentially what we want to do is we want to sum the variable manufacturing cost, including direct materials, direct labor, variable manufacturing overhead, and then we want to add to this on a per unit basis the fixed manufacturing. Well, you notice that we manufactured, or part of our budgeted manufacturing is 3,440 units. So let's do this calculation. So the first thing you want to do is we want to sum the variable manufacturing cost, and then we want to add to this the fixed cost, but we want to divide the fixed cost by the number of units, which is 3,440. Now you notice in Excel that what I did is the fixed cost is divided by 3,440. I put this in parentheses so there would be no confusion in Excel in terms of what part of the calculation we did first. So what we have is we have our fixed cost, or our manufacturing cost per unit of $215. Now we want to focus on the numerator. The numerator is the income plus the additional cost associated with the selling and administrative expenses. So you notice that the first thing that we want to look at is we are attempting to get a 25% return on investment, and the total investment is $873,760. So this was our commitment. So this essentially is our return on investment is going to be the 0.25 times the 873,760. So this is going to be the return on investment in terms of net income, but we want to use this calculation from the perspective of a per unit basis. So we want to divide this by 3,440 units, and we get $63.20. We want to add to this our variable and fixed selling and administrative expenses. So where does this come from? Well, we have $10 in terms of variable, selling, and administrative, and then we have a total of $87,720 in terms of fixed. So this is simply just adding the $10 plus the 87,720 divided by the number of units. And you notice that we put this in parentheses, and that's $35.50. So if we add these two numbers together, and these two numbers together are going to be $99. So if we take $99 divided by 215, and we're going to get, and let's make this a percentage, and we're going to get 46%. It's not exactly 46%, but that's close enough. Okay, now what we want to do is we want to use this information to identify the targeted price. So the targeted price is going to be the cost, which is 215, and then we're going to add to this the markup, which is 215 times the 46%. And we're going to get a price of $314.23. So what we're now looking at is our selling price is $314.23. Let's now go through the calculations and just validate that what we came up with actually works. So what we have here is we have a typical income statement where we have sales minus cost of goods sold gives us gross profit. We then subtract our sales and administration and get our net income. So what is our sales? Well, again, we're assuming a budgeted amount based upon 3,440 units. So what we're looking at here is we have the sales price, which is $314.73 times the 3,440, which is the number of units, and we have total sales of $1,080,960. Our cost of goods sold is going to be the manufacturing cost. So our cost of goods sold is going to be our $104,000 fixed cost plus the variable expenses, and the variable expenses are the sum of these items here, and we multiply this by 3,440 units and come up with our cost of goods sold of $740,400. So gross profit is essentially our sales minus our cost of goods sold. Okay, sales and administrative are these expenses that we see down here. So it's $10 per unit plus the $87,720. So we're going to add the $87,000 plus the $10 times the 3,440 units. And this is 122,120. Our net income is going to be our gross profit minus our sales and administrative expenses. So our net income that we see right here is the $218,440. Okay, so what is our return on investment? Well, we said we wanted a 25% return on investment. Let's see if this actually works. So the return on investment is going to be net income divided by our investment. So our investment is $873,760, and this is 25%. So that's what we were looking for. The other piece of this is going to be our markup. We said that we wanted this 46% markup, and let's see if we actually got that. So where is our markup coming from? The markup is going to be our net income plus our sales and administrative expenses. We're then going to divide this by our cost of goods sold, and this is 46%. So again, where did that number come from? It came from our net income plus sales and administrative expenses, and then we're dividing this by our cost of goods sold. So what we have is we have a markup of 46%, we have a return on investment of 25%, we have our sales price of $314.23. So hopefully this helps. Thank you very much for your time, and we'll see you soon. Bye-bye.